This video is about an indicator that I completely forgot all about. This is called the Traders Dynamic Index, which is this thing here down below. It's got a couple of squiggly lines and a couple of and there's an overbought and an oversold. This one here is put together by Uncle L. This guy here, just Uncle L, sorry. And there's a whole stack of information here for you to read, okay? And it's this guy here. This is on TradingView. The actual indicator itself, the only things I've changed is I've turned off the Bollinger Bands. I don't use those. And I've also just turned off the bars. And I've also turned off these alerts. You can see all these little buttons here. And I've also just turned off this as well. That's the only thing I've done on the style tab. Oh, and the plots. I don't need the plot, although it is good to have. It sort of gives you maybe a bit more visual confidence. On this side of the actual indicator itself, the only thing I've changed is this length band. It was 34, and I've changed it to 20. And if I expand that, you can see the yellow line change. See how it's changing? Okay, it was 34. I've changed it to a 20. Why 20? And well, I use 20. That is my go-to. Oh, get rid of that. 20 is my go-to for determining trend on a 15-minute chart, which is this thicker red line or thicker green line. Okay. Now, let me just turn that off. You'll see here I've got Heikin-Ashi bars. In the original setup for this, actually, can I just rewind for a second? The reason I actually became interested again was I just came across this this post here on Forex Factory, and when I say a post, there's over 1,500 comments on this, and it just stirred the interest in me again. So I thought, you know what, I'll just put it back up in the charts and just see how it is for me after all this time. Okay, this guy here goes through a strategy which you might want to use. I don't really use it the way that he does, but it doesn't matter. So how do we trade this thing? Well, this yellow line is the moving average, really. It's that they call that the trader's dynamic strength. Okay, so if it's above this zero line, the black line, you know, the market is strong, it's moving up. And if it's below the 50 zone here, this middle black line, it's the market's deemed to be going short, as in the indicators. So the green, if the green goes above red, we're looking for longs, and of course if it goes above the yellow, now we're really into a strong bull market. And of course here it's still bullish, but it looks like we've got some consolidation, as you can see here. And now the market's starting to turn over, and of course if green goes below red and both of those are below yellow, you look for shorts. Do you get it? You understand? So you can trade it really strictly like that, or you can just trade it loosely where you don't actually have that middle line. You can actually turn that off. Just here, just go to turn, where is it? Just turn off that middle line, and you can just trade it like that. But I like to just keep it there. It can't hurt. So that's basically it. And of course you want to be watching the bars. You know, the most important thing, you need to be watching, you know, what's price doing. This green line's supposed to represent what price is doing. Okay, as you can see, it's come down, it's pulling back, it's coming down, it's pulling back, it's coming down, and now it's starting to turn over. And so that's sort of mimicking what price does. The person that actually came up with this concept, I just forget his name. His name's Dean something or other. It's in here somewhere. Just do a search. If you go through this, you'll be able to. This guy here talks about it. His name's Dean. I just forget his surname, sorry. I think there's some YouTube videos as well. Anyway, I don't want to digress too far. So the originator of this suggests that it's best used with Heikin-Ashi. So this is just Heikin-Ashi, okay? And then the originator of this whole concept suggests that you use these moving averages. He does suggest that you use a 5 smoothing moving average. I don't know what that means. A smoothing, is that it there? Anyway, he does go on to say that if you don't use a 5 smoothing, use an 8 EMA, and you have one set to high and one set to low, so it makes this channel. And as you can see here, so for a short, you obviously would want to see the red bars poking down below the yellow line, as you can see here. And a long, you would want to see the bars poking up. That's going to give you, you know, it's like visually you can see it. And of course, if it's in between, it's consolidation. That's the way that I would be looking at all this. You can see here the bars start to poke down a bit. You might be looking for a short, and the indicators here are helping you. It's a great visual system, and it's really, it's easy to trade after the fact. Of course, once everything's printed, but when it's live, it's different yet again. So what else can I tell you about this? That's essentially it. So, you know, if you want to go short, you wait for green to, you know, shoot through the red, then go under yellow, and obviously you want to see it the same here on the charts. Go short. There you go. This is crude oil, 15 minutes. Looking for another short. You can see green didn't quite get through. And as you can see, the market's sort of pushing back up. And just here, there was a short, 40 cents. And then you can see here, green pushed above the red and the yellow, and you would be looking for longs right in there. And, you know, if I just go to another night, another session, same sort of thing here. This one's a little bit whippy. You might have got something out of that. Then eventually it settled down into a whole bunch of longs. Where do you get out? I would suggest that any time a line is broken, you would want to be sort of thinking about getting out. Maybe. Look here, would you get out? I don't know. You'd have to just judge that one. You know, you might have stayed in. Probably better to stay in. Here, would you get out? I would definitely be looking at getting out if I saw this green starting to really come too close to the yellow, and then just get out, wait for it to turn around as it did, and then go long. It's going to change this to candles just so we can have a look. That's where we were with candles, so it can just work exactly the same with candles as well. It doesn't matter whether you use Heikin-Ashi or candles, I think. But yeah, Traders Dynamic Index, very interesting little indicator that you could give a go on your charts. I'm just going to put on the CCI and just show you something. I don't know if you're going to be able to see it here. The CCI does exactly the same with less with less lines. I have not found anything to beat the CCI. This is set up as a 20 and a 25 moving average. I have tried numerous indicators and nothing beats the CCI. Okay, it just seems to just be more responsive and with less noise in the indicator. So like look how many you've got here. 1, 2. You've got 3 lines here. You've only got 2. But you know what you could do is use both of these together, and I did on Friday. Let me just get to Friday. Friday in crude oil. I did on Friday. Let me just remove the drawings. I actually didn't use these EMAs. I used my own based on a 20, and I thought this was a great combination. They're both doing exactly the same thing. However, I just think it's maybe good to have 2 indicators, they're slightly different, but you can see here that the yellow moving average is exactly the same as the one on the CCI. Mind you, this is a 25 on the CCI, and this is a 20 on the TDI. You can see crossovers were around about the same. What I like about the CCI is it's telling me levels earlier, which is this 100 here, where this is why I don't like the RSI. The overbought levels, as I say, they're really far away. This is why I like the CCI. It gives me really, I feel like I'm really connected to the market. I can really see when it's going over and then turning back. But yeah, you could incorporate both of these indicators on your chart, and that just might help you visually stay in a trade or not trade. This here, I've been trying to work out which indicator gave you the best indication, but you know what? They both did exactly the same thing. So you can just see they're both exactly the same. RSI, CCI, just doing exactly the same thing. It's amazing, isn't it? All right, go and practice this and see what you think. You might come up with another idea. Catch you later.